Good morning, everyone. Thank you for joining us this morning on our webinar on the proposed amendments to the transfer pricing bylaws and the impact on Zakat payers. Just by way of introduction, my name is Shiraz Khan. I'm the head of tax at Al Tamimi across the Middle East and North Africa. I have over 20 years of experience in different jurisdictions, accountancy firms, law firms, and also I was the global head of tax in-house as well. I've been in the region now for over 12 years. Prior to that, I qualified in the UK as a barrister, and it's been a very interesting experience. I'm joined by my colleague Ioannis Nanos, who will introduce himself.
Good morning, everyone. My name is Ioannis Nanos. I'm a transfer pricing expert. I have more than 10 years of experience in transfer pricing. Before coming to the Middle East, I worked for big four firms in Luxembourg and as well in London. And in the last 5 years now, I'm in the Middle East, focusing mainly on transfer pricing from compliance, documentation, and as well planning and advisory projects.
Thank you, Ioannis. Moving on to our agenda for today, of course the focus is transfer pricing, and since many of you may be unaware of what transfer pricing is because perhaps it hasn't impacted you in the past, transfer pricing deals with related party transactions. So where you have related party transactions, transfer pricing is important for tax purposes. And the reason why it's important, when you have transactions, commercial transactions in an open market, as a seller, you're looking to maximize the sales price. As the buyer, you're looking to pay the minimum price possible. However, when it comes to related party transactions, there's a difference. And the difference is because the parties are related, you could actually manipulate the price for tax purposes. So of course, if you reduce your income, then the sales price, and you inflate the expenses, then you could end up in a situation where you have less profit and therefore less tax. And also the situation is very relevant when it comes to multinational groups. You may have multinational groups based in different countries across the world, and there may be a tendency for these multinational groups, because although they may have different companies in different countries, ultimately, they're under one group umbrella. So in order to maximize the return to the shareholders, there's an incentive for them to move profits from high tax countries where the tax rate is very high and they pay more tax, to low tax countries. And if they do that, they're able to reduce the tax on a group-wide basis. So this is very beneficial for them. And there's been a lot of focus internationally on transfer pricing as well. Back when the previous recession started in 2008, 2009, a lot of governments were grappling with budget deficit and recession. So tax was one of the obvious ways that they could actually increase the revenue of the country, and transfer pricing in particular was a focus. So the G20 countries approached the OECD and they asked them to look at ways in which global tax avoidance can actually be tackled. And the OECD undertook a project called the BEPS project, and they recommended 15 action points, many of them which were focused on transfer pricing and focused on aligning the pricing with the actual value. So that's why transfer pricing is becoming increasingly important. And in the context of Saudi Arabia itself, as some of you may be aware, Saudi Arabia introduced transfer pricing bylaws in 2019. And they impacted Saudi companies for the first time for the year 2018. Now, when they were initially introduced, they were only applicable to taxpayers and also mixed taxpayers, not to Zakat payers, except to the extent of the country-by-country reporting rules. Now, of course, there's been a public consultation document which was issued earlier in July, and the public consultation closed at the end of July. And the main consequence of the public consultation is that these transfer pricing bylaws will be extended to Zakat payers, in addition to taxpayers and mixed taxpayers. So we're going to walk you through and remind you what transfer pricing is, what some of the main requirements are, what the proposed changes are going to be, what are the main issues which will be faced by Zakat payers, before we go on to conclude with what you should be doing in order to deal with the transfer pricing changes. And then in the end, we'll of course have a question and answer session. Just a few housekeeping points before we begin. The session is being recorded, and we are going to share a copy of this recording after the session. The audience is muted, so please do submit questions through the Q&A function. We'll of course try our best to address the questions at the end, and if not, we'll get back to you by way of email. There will be poll questions, so please do be ready and participate in these questions, because it'll be important to have your view on where you are in terms of the preparation. If you can't hear us, please make sure you're connected to your audio by choosing either connect through the computer, audio, or phone. So just to begin with the first poll question, how prepared are you for the expected implementation of the revised TP bylaws? Are you well prepared, somewhat prepared, or not prepared at all? Okay, thank you for participating. According to the responses received, no one is well prepared, which is not surprising because this is impacting Zakat payers for the first time. 55% of you are somewhat prepared, which also isn't too much of a surprise because you may be aware of transfer pricing bylaws in Saudi Arabia, given that they impact taxpayers, and some of you may also be mixed taxpayers, so it makes perfect sense. But of course, there is some time to get prepared, and that's why we're hosting this session, and hopefully that should help. And just to hand you over to Ioannis, who's going to talk about the existing transfer pricing regime and the proposed changes.
Thank you, Shiraz. So to start with, as Shiraz mentioned before, a few months ago, back on the 4th of July, ZATCA issued a public consultation document on suggesting some amendments on the KSA TP bylaws. These changes were basically, it's not really redrafting of the KSA TP bylaws. The main idea is basically that the existing TP bylaws that are mostly applicable to income and mixed taxpayers will be also extended to Zakat payers. That means that the provisions of the TP bylaws should also be applicable now in the case of Zakat payers. Since the initial publication, ZATCA gave a time of approximately a month, basically by the end of July, to the public to share their opinions and views around the suggested changes. We know now that ZATCA is at the stage of been collecting basically all this information from different parties, from the consulting community as well. And the idea is that soon we'll be issuing the final revised TP bylaws. By the way, we are expecting that this is going to happen quite soon. We have seen also in the past, as Shiraz mentioned before, that when they issued the draft TP bylaws back in December 2018, a few months later, in February 2019, just 2 months later, they issued the final TP bylaws. So having that, keeping that in mind, we expect that most likely ZATCA will be issuing the revised TP bylaws within this calendar year. So with this, we can move please to the next slide.
Just a point to add to that, it's not clear at this stage when the proposed or the new bylaws will be effective. But if you look at the previous precedent in 2019, the bylaws were issued in 2019 and they were effective for the financial year 2018. So a similar precedent could be followed. And if it is followed, then of course, if the regulations are issued, early part of next year, then they should be effective for the 2022 financial year. But that remains to be seen.
So I think at this stage it's maybe good as well to give a historical overview of transfer pricing in Saudi Arabia. As you can see from this timeline, in a few years major changes have happened. So since 2018, since September 2018, Saudi Arabia signed on the OECD based on erosion profit plan, on the action plan. So that was a key commitment from the kingdom to basically follow the latest tax developments. And this, as a result of this, was basically to introduce a few months and a few years later transfer pricing documentation. So for the people that are not really familiar with OECD or the base erosion profit shifting plan, OECD stands for the Organization for Economic Cooperation and Development. It's an international organization that drives the global tax agenda. Basically, they issue guidelines and guidance around tax policies. It's not mandatory for the members, for other countries apart from the members, to follow it, but it's basically showing, what the country should be doing in order to tackle tax avoidance. So, with the base erosion profit shifting project, was basically a project that included different initiatives. And one of these was basically how to strengthen countries, their transfer pricing documentation, and how to make sure that tax authorities are getting their fair share of taxes. So Saudi Arabia wants to be, and it's part of this, global tax, of the changes in the global tax agenda. So by adopting the BEPS plan, as a next step was basically to introduce in February 2019 transfer pricing bylaws. Basically, this bylaws is basically the transfer pricing, the core of the transfer pricing framework in Saudi Arabia, that was mostly applied to income and mixed taxpayers. As we will see later as well, a few of the requirements were also as well applicable to Zakat payers. Following this, in March 2019, ZATCA issued the first edition of the transfer pricing guidelines. These guidelines follow to a big extent the guidance from the OECD. Of course, there are some specifics. It's a very big report. It's around 100 pages, 200 pages report. There have been some updates on this a few years ago. Was basically last year in November. It was the third edition of these guidelines. And later on, a big step, and again, as a continuation of Saudi's commitment to follow the global tax agenda, was basically that Saudi signed up for the inclusive framework with regards to Pillar 1 and Pillar 2 of OECD. So basically, again, this is Pillar 1 and Pillar 2 is, for the ones that they don't know, is basically the next step of BEPS. Is many people they call it BEPS 2.0. Is basically a project, a plan to tackle the challenges coming from the digitalization of the economy, of the global economy, and also with Pillar 2 is as well the introduction of the global minimum tax. As you can imagine, transfer pricing, it is part of this picture. It's Pillar 1 and Pillar 2. It's not only transfer pricing, but transfer pricing remains at the core of these issues. So to continue this and basically to make sure that the transfer pricing rules are applicable and not only to income and mixed taxpayers, Saudi Arabia has decided to extend this, and there is the public consultation document that it was issued back in July. And as we just said before, we expect that the final revised TP bylaws will be issued within this year. Again, it's still an expectation, but with what we have seen before, this will be most likely the case. And the other point is as well that the TP bylaws will be most likely applicable for the financial years ending 31st of December 2022. So this is again similar to what has happened in the past, that once the rules are out, are going to be applicable for as soon as possible. So with this, we can move please to the next slide. I think it's important as well before we talk about the requirements and the changes that are happening in the law to give a bit of context on transfer pricing. Shiraz previously gave some very good examples and an explanation on transfer pricing. So when someone is talking about transfer pricing, basically transfer pricing deals with any pricing that has to do with transactions between related parties. In the world of transfer pricing, there are basically three main concepts. The first concept is about related parties. So you need to know and you need to identify what are these related parties. The TP guidelines provide specific guidance on how to define the related parties. Of course, each country, depending on its transfer pricing legislation, has its own legislation and provision around related parties. So in Saudi, in terms of related parties can be considered either in terms of ownership or in terms of control. These are the basically, or management, these are the basically two criteria to define and which parties can be considered related. The other concept is around control transactions. So basically, which transactions, and we're going to touch base on this on the next slide, which transactions are considered controlled, what type of transactions, let's say royalty payments, interest expenses, etc. And the third pillar of this, and it's one of the most crucial and important things in the world of transfer pricing, is the arm's length principle. Basically, the arm's length principle requires that the pricing of any transaction between related parties should be conducted in a way that if these parties were independent. So this comes across in the legislation in Saudi Arabia. It's at the core of this legislation. It's easy to say, but it's quite complex in terms of application because it really depends. That's why the TP guidelines in Saudi they are so lengthy, because it depends on the type of transactions, on the specific industry, the application of the arm's length principle. And of course, there is guidance, and this also helps taxpayers on identifying and assessing if certain transactions are conducted on an arm's length basis. With this, I think we can move to the next slide. Thank you, Shiraz, for this. So basically, in terms of, as we said, in terms of transactions, there are four buckets. The first one is around tangible property. So with tangible property, you can have one company in country A producing goods, and then you have a company in country B that are basically these two parts are related, and then you have a company in country A selling these goods, distributing these goods to country B. This is basically one example of that relates to tangible properties and transactions around that bucket. In terms of a very common type of transaction that we also see it a lot in Saudi Arabia is around services. So you can have, as an example, a shared services center that provides different type of services to its a group companies, as an example, human resources, IT, different types of transactions. All these entities are benefiting from these services, so they should reimburse the service provider for this. Apart from this, you can also have transactions in relation to IP, intangible property, intellectual property. So basically, as an example, the headquarters, they are granting the brand or a trademark to the group entities, and the group entities are paying a royalty for the use of the brand and the benefits they're getting from the use of the brand. Last but not least is as well financial transactions. So you can have cases of loans, or in case of guarantee fees. So one company that is in a jurisdiction is providing to another related party a loan. Then there is an interest payment with regards to this loan. So basically, these are the four key types of transactions. Of course, we have to mention here that in the TP bylaws, there is no distinction between domestic or cross-border transactions. So all transactions, even if they're happening within the kingdom, they fall still within the TP bylaws. And all of these transactions are quite common in terms of what we have seen so far in Saudi Arabia. Shiraz, you can go please to the next slide. Thank you. So for this now, I think it's good to give also as well an overview of the transfer pricing existing regime in Saudi Arabia, and as well what is going to be applicable in the case of Zakat payments. So effectively, I mean, from this slide, may someone consider that there are a lot of requirements, but effectively they are falling under 3 pillars. So the first pillar relates to the TP disclosure form and the affidavit. So this basically are compliance requirements related to the return. The next pillar is the CbCR, the country by country, the report and the notification as well. And the last 2 is the local file and the master file. So basically, all these requirements, they were already part of the TP bylaws. And as we mentioned before, the CbCR, the country by country notification, and the report has already been applicable to Zakat payers from the existing TP bylaws. Now, with the changes, the suggested changes in the public consultation document, all these requirements will also be applicable in the case of Zakat payers. Not only the CbCR, but as well the disclosure form, the affidavit, the local file, and the master file. Now, what does that mean? So basically, in terms of the disclosure form, what is the requirement in terms of content? So in the disclosure form is basically a form that you are describing your related party transactions. You include which are the parties involved in these transactions, the type of transaction, if it is tangible goods, if it is services, if it is financial transaction. Also, you are mentioning the value of the transaction and as well the type of methodology that it has been followed to test and assess the arm's length nature of this transaction. The disclosure form is now accompanies the tax return, and in the future will also accompany the Zakat return. Together with this is also coming the affidavit. The affidavit is basically a certification that the taxpayers basically certifies in the form that the group's TP policies have been followed also by the local entity. In terms now of the local file it's a report that is basically describing the overall businesses of the local entity. There is a description of the control transactions that this entity has been involved in. But not only this, there is also an analysis around the function analysis called industry analysis. So basically, it's a report that you are describing the overall business activity of the entity, and also you are including an evaluation of and assessment on the nature of the control transactions of the specific entity. In terms of the master file basically gives the big picture. Is the document, is the report that basically gives the overall supply chain and value chain within the group, the key material intra-group transactions within the group, also key intangibles within the group. So it's basically trying to give the overall picture, and this together with the local file helps the tax authorities understand a group more and what are their operations and how the value created by the local entity fits in the overall value chain of the group. Last but not least, as we said before, is the country-by-country report and notification. These requirements have already been applicable to Zakat payers from the first TP bylaws. So basically, in the country-by-country report, it's a report that includes financial, but as well qualitative information. Financial information can be in the form of turnover, and number of employees. This information are on a jurisdictional basis. So if you have operations in 10 countries, you need to present this to the tax authorities, different financial information for all of these countries. And apart from this as well, you also include some qualitative information. As an example, what are the type of, if you characterize an entity, is it a distributor, is it a service provider, is this a headquarters? So this is part of the country by country report. And the notification that is basically submitted by the entities that they are not filing, most likely the CbCR report, but it notifies the other entities, the local tax authorities basically, who is the entity filing the CbCR report. These requirements, they come with certain thresholds. In terms of the disclosure form and the affidavit, there is no threshold. Basically, a business that is being involved in controlled transactions, they need to file together with the tax return or the Zakat return their disclosure form together with the affidavit. And in terms of the local file and the master file, the local file basically, the master file is mandatory for entities that they have related party transactions above 6 million Saudi riyals. And the CbCR report is requirements are applicable to entities that they have consolidated group. At the group level, they have consolidated revenues above 3.2 billion Saudi riyals. With this, I think we can go to the next slide. So, as we said before, the key change in terms of the proposed amendments, the main suggestions from ZATCA is the extension of the TP bylaws to Zakat payers. So basically, all the provisions of the TP bylaws will be extended as well to Zakat payers. There are, however, certain specifics. So, as an example, the TP disclosure forms require for income and mixed taxpayers certain information. This information will be still required by the Zakat payers, but on top of this will also be a requirement on assets and some other information that they need to be revealed and be part of the disclosure form. Additionally, in terms of TP disclosure, TP documentation, we're not expecting any what is already in the revisions that the same thresholds that they apply for income and mixed taxpayers will continue to apply for Zakat payers as well. And as we said before, domestic transactions and as well cross-border transactions will be part of the bylaws. And another important amendment is basically that in the revisions, ZATCA has also included that any basically the statute of limitation that is part of the existing Zakat regulation. So basically that means that tax authorities can go back to 5 or 10 years and check the Zakat return and see if the Zakat return is in line with TP bylaws and the provision. So it gives basically the option to the tax authorities, and also we should mention as well here that the arm's length principle has already been part of the Zakat regulations. So by breaking the statute of limitations in the TP bylaws for Zakat payers, it gives the option to the tax authorities and the right as well to go backwards and check if the transactions, the control transactions that the Zakat payers have been conducting in the past before the implementation of the TP bylaws, if they were on an arm's length basis or not. Yeah, with this we can move basically to the next slide. So now I think we have given a bit of context around transfer pricing and what have been the transfer pricing documentation in Saudi Arabia. But now it's a good stage to present as well some common areas of concern. So this is, by the way, something we have already seen before. It's again basically the same story that we have seen a few years ago with what happened for the income and the mixed taxpayers. So again, in terms of areas of concern, we are seeing some repeating patterns. So to start with is basically the arm's length pricing. So there are many cases with discussions we have with clients that they are aware that it's the transactions they have between related parties are not conducted on an arm's length basis. As an example, there are companies that belong in the same group. One company is providing an interest-free loan to another group company. As you can imagine, this is not arm's length. Or you have as well another common issue we see is basically you also have shared services. Senders, they provide services. Group entities are receiving the benefit, but they don't pay anything back. So again, this is not in accordance with the arm's length principle, and this can be easily now challenged by ZATCA. So one key area of concern is around making sure that your transaction is at arm's length. Another area as well is in terms of support for this, in terms of economic support, or as we call it in the world of transfer pricing, benchmarking support. So basically, what is this? We have clients, they say, I have management services that I'm providing on a cost plus basis, 5% or 6%. The question is coming, do you have any support on this? How you came up to this cost plus 5%? Have you done any benchmarking analysis? Is the benchmarking analysis conducted in line with the requirements of the KSA TP guidelines? So just keep in mind that in cases that you have any pricing already in place, it doesn't mean that this pricing is on an arm's length basis. You need to be able to prove that you have followed certain approaches that already prescribed in the KSA TP guidelines to prove that the rate that is used is on an arm's length basis. So you need to rethink, if you haven't done a benchmarking study, how to do a benchmarking study. And the last pillar of basically support around your transfer pricing story is with regards all the other supporting documentation. So as an example, in transfer pricing, you always require to have intercompany agreements. So what does it mean to have intercompany agreements? Is like in any other case when you have a contract with a third party, when you have an agreement with a third party, you need to have a contract in place. So transfer pricing is not different. You also need with your related parties to have in writing agreements that they show what are the parties involved, the transaction in that specific case, the pricing that has been applied, things like that need to be part and they need to be documented in a legal agreement. On top of this, you also are required to have what we call transfer pricing policy. So, as in the example of before we said about the shared services, you need to say in your TP policy basically what are these services. You need to explain the services. You need as well to have a rationale on, let's say, you are allocating this costs for the provision of the services on a specific with a specific approach. What is your cost allocation mechanism? What is the basis for this? This needs to be part of your TP policy, because the TP policy can also be used for you when you produce your local file. So as you can imagine, all of these things, and together as well things like invoices. Do you have the proper, are you invoicing in a proper way or not? So all of this basically are helping you to create your line of defense towards the tax authorities, and are basically can be used as your own basis to say your own story to the tax authorities. If you don't do this, the risk there is that tax authorities may come and they may have their own story about your related party transactions. So it's always best to prepare yourself, and now that there are the requirements there, and most likely you will have to, ZACA payers will have to comply with these requirements, is basically how can I be best prepared and best to defend my own transfer pricing position. So in order to do that, not only from a reporting perspective, because this will be already part of the law, but also from risk management perspective, is this the right story? Is this the right, basically, this is what do I want to convey to the tax authorities? Have I thought about the pricing correctly? Have I thought about TP policies, etc.? And it's not only transfer pricing, I mean, it's other things as well, like, I mean, that can have an impact, because someone may say, I have only domestic transactions within Saudi Arabia, why I should care? I mean, I pay more tax in one company, I pay less tax in the other. So all of these things, they need to come because you may have as well, as an example, VAT implications on your related party transactions. So try to think about this in a more holistic way and approach. So with this, if we can, Shiraz, go please to the next slide.
Yeah, just a couple of points to add to that. I think it's also important to bear in mind the relationship between transfer pricing and other taxes as well. As Ioannis mentioned, transfer pricing can impact other taxes. So, for example, if you're not in a VAT group and you're related parties, and there's a transfer pricing adjustment, ZATCA, the tax authority, could potentially subsequently, after you've done the transaction, request you to pay more VAT because you reduce the value of the transaction. Well, that's one implication. Another implication could be with customs. So you may be importing goods from a related party from overseas, and you've actually paid the customs already, and subsequently there's a transfer pricing adjustment, meaning that the value of import has now increased. How would that impact your what you do in terms of customs now? Do you make a disclosure and do you address it? Do you pay additional customs? And also in terms of withholding tax. Now, withholding tax usually is not so much of an issue because when you're making a payment to an overseas company, you usually take a deduction from your income as well, which reduces your profits. And therefore, there's no real incentive for you to actually to reduce the amount of the payment. Usually it's the other way around. You're looking to increase the payment and therefore claim a higher deduction. But there can be in situations, for example, where you have an expense which is not deductible, and therefore you want to reduce the withholding tax, and you reduce the expense, and in that case, and therefore reduce the withholding tax as well. So in those types of situations, there could be also a withholding tax impact as well.
Yeah, thank you, Shiraz, for this. I think it's also very helpful to consider as well, not only the transfer pricing implications, but also the other direct or indirect tax implications. So, having said all of this, I think it's also important to consider from a timeline perspective what is the best way and how someone act in this case. So, what we are suggesting is basically a phased approach. So, Zakat payers, they should, by the end of this financial year, by December 31st, 2022, basically conduct a transfer pricing impact analysis. And what does basically that mean is basically try to firstly identify which are the control transactions you have. So basically, what are the related parties? Which transactions are considered controlled? So are any transactions like services, financial transactions? All of this, of course, needs to be in line with the guidance that has been provided by the KSATP guidelines in terms of defining your related parties. Then seeing monetary transactions, but also as well non-monetary transactions. As an example, we said before that certain services that are being provided, entities are receiving benefit. This is also a very common case for Zakat paying groups, but there is no charge. It doesn't mean the fact that there is no charge that there is no transaction there. So someone needs to take a holistic view on this and rethink about all of these matters, and also which transactions can be and will be considered control transactions. And finally, because the books are going to close by the end of the year, taxpayer like Zakat payers will be able to make any adjustments they require before the year end. This is basically also we're going to help them a lot in case of of the transfer pricing compliance, because what we mean with that is that when they have to file the Zakat return, the affidavit and the disclosure form should also be coming together with the Zakat return, and this should take place before the filing of the Zakat return by April 2023. Later on, once the first compliance stage has been completed, then is the time for the second compliance stage, that is basically the local file, the master file, and the country by country report, and this should be done basically by mid 2023. So, having said this, the key message is that we, Zakat payers, they have much more time in their hands compared to what has been seen before for income and mixed taxpayers. Income and mixed taxpayers, they were just given a few months basically to comply with the rules and prepare their transfer pricing documentation. The difference is that Zakat payers, they have the time to make any necessary changes now, because if you have transactions as an example that are not arm's length, and then you have to document these transactions, you can get very tricky on how to approach this. So the suggestion is basically that you should act now, that there is enough time to make the changes, and then the compliance stage will come. Of course, we understand that this is, especially for the first year, it can be a complex and very cumbersome exercise, but once the first year has been completed, then the following years, they most likely will be easier in terms of work required if you have already set up your transfer pricing in the right way, and then there are not expected major changes to your transfer pricing practice. So with this, I think we can move to the next slide. Is on the poll question.
Okay, so the next poll question, do you expect that the revised TP bylaws will impact your Zakat requirements? Yes, significantly, somewhat, or not at all? So thank you for participating in the poll question. It looks like 50% of you said yes, significantly, and 50% somewhat. And that's probably to do with the fact that, as I said, some of you may have more related party transactions than others, and it's probably a reflection of that. So just to move on to the next slide, what you should do to prepare. I think the key point is that, of course, whenever there's a significant change which happens to the legislation, you have to look at the legislation and assess how it impacts you. Now, I think what really has changed from previously, there hasn't been too much of a change when it comes to income taxpayers or even mixed taxpayers. Both of these were already subject to the transfer pricing bylaws previously, and they would have already been complying and they would have already been impacted before, so they're probably well aware. However, on the other hand, those of you who are pure Zakat payers and you're only subject to Zakat, not income tax, this probably is a very, very big change, especially if you're a group and you have a large number of related party transactions or any related party transactions at all. So this is something that you now have to think about. You have to, once the TP bylaws are updated, you have to now assess the impact on you. You have to understand the rules. You have to see what you have to do in light of these laws in order to comply. Or sometimes you may need to make changes to your business based on how it impacts you. So I think the starting point is, waiting for the TP bylaws to be updated and then assess the impact. Reviewing your intercompany transactions, identifying which transactions are controlled transactions, and then going about documenting the relationship and how you're pricing the transactions. As Ioannis said earlier, it's better to be proactive, and you need to be prepared. If you fail to prepare, then there's going to be some risk ahead. So it's better that you document the relationship you have and the basis on which you calculated the price, and this could be used as a starting point for your defense with the tax authority. And it's important to maintain contemporaneous documentation as well, because sometimes you may have documentation in place for many, many years, and with transfer pricing, you always need to be reassessing the situation. Has things changed in the marketplace, and therefore do you need to update the benchmarking? It's also important for you now to start thinking about not just the transfer pricing documentation, but additional documentation which you need to have in place in order to support your transfer pricing position. So, things like intercompany agreements. Maybe historically you haven't had any intercompany agreements, but now, given that you'd be impacted by transfer pricing, and if you have related party transactions, the starting point for the tax authority in order to understand the transaction is quite often the agreement. Therefore, it's important to document the agreement and also make sure that the substance of the agreement is aligned with the actual form. So the agreement is supposed to reflect what you're actually doing, and if you have an agreement in place which has no relationship with reality, then in that case the agreement is actually a sham, or is completely incorrect. So this is your defense in terms of demonstrating the transaction that you've entered, and also to show the tax authorities what you're actually doing. So very, very important. It's also important to have a transfer pricing policy in place. Many companies, they don't have a transfer pricing policy, and this could be useful defense as well before the tax authority, because the tax authority want to understand your approach to transfer pricing as a group, and therefore what your policy is. Are you aggressive? Are you trying to comply, and what kind of approach you're taking? It just takes me on to the next slide, which is how best you can prepare. And again, it's the same as the key takeaways. You do need to review your intercompany transactions and your business model. You need to identify the transfer pricing risks, think about how things could be done differently in order to mitigate these risks. You need to develop local or global transfer pricing policy where you're a group of companies which are part of the same group for transfer pricing purposes, because you're related. Once you've got all of this in place, you need to implement your transfer pricing policies. You need to have the intercompany agreements in place, have all the relevant documentation, which I talked about. And in terms of the transfer pricing documentation as well, so the local file, master file, country by country reporting already you'll be familiar with, because this is something that already impacted you from 2019. So that's something, if you're not doing that, you should be, because there's already a few years of non-compliance associated with that. And then having the economic analysis to support the pricing of your intergroup transactions. So making sure you do the benchmarking and try to revisit this every year to make sure that everything is contemporaneous and current. And then, obviously, of course, when the time comes, you need to prepare the transfer pricing disclosure form. You'd also need to submit the tax returns and file the TP documentation when the tax authority requests it. And then going forward, in the event the tax authority does an audit and they look at your related party transactions, in this case, you need to defend, whatever documentation you have in place and your transfer pricing policy and the approach that you've taken. So that's something that you need to handle as well. And subsequently, once there's an assessment which is issued by the tax authority and they've made an adjustment to a related party transaction for tax purposes, then you need to think about defending that initially, dealing with the tax authority, and then subsequently appealing against this to the committees. We are seeing an increased number of disputes coming from transfer pricing transactions, and therefore it's very, very important to make sure that you have the appropriate documentation and support. In many cases, transfer pricing is not an exact science. So of course, there's a law there, but it's not black and white. So it's up to you to demonstrate and support the nature of your intercompany transactions. Of course, we're a full-service law firm. We specialize in tax across the region and also in Saudi Arabia. And transfer pricing is also one of our specialisms as well. So we'll be happy to support you in all of your transfer pricing requirements, including compliance, any queries you receive from the tax authorities, in terms of analyzing your business model and related party transactions and analyzing the risk, to have your transfer pricing policy in place, and also to assist you with the actual documentation as well. I think one of the advantages clients have with working with someone like us is because we're involved in disputes quite heavily, and it's better to involve us at an early stage where we could help you mitigate some of the risks and some of the challenges which are being faced in the appeals. So we'll be happy to support you as a leading law firm and specialized in tax and transfer pricing. Moving on to the Q&As. Ioannis, we have a bunch of questions here. So the very first question is the arm's length principle applicable to Zakat payers?
That's a very good question. As we said before, basically, one of the things is that Zakat regulations already from 2019, they include the arm's length principle. So basically, Zakat payers, they had, irrespectively of the TP bylaws and the amendments in the TP bylaws, they should have been already complying with the arm's length principle. And by the way, as we mentioned before, with including the statute of limitations of the Zakat regulations in the amended TP bylaws, it gives the right to the tax authorities to go backwards before the implementation of the TP bylaws to Zakat payers and basically request Zakat payers to prove that their transactions have been conducted on an arm's length basis, even for years before the final implementation. So yeah, that's it's already a key idea, but now the key message is basically that it's not only a good to have or you should have, it's basically becoming a must have, because together with the arm's length principle, you will need also to file your disclosure form, file the affidavit, prepare and maintain a local file and master file that you need to show that you have been conducting your transactions on an arm's length basis.
Thanks, Ioannis. There's another question here. Will a company owned and managed by company employees, in other words, employee company, be considered a related party in the context of providing services to the same company they work for? How will the TP affect the transaction, the services between such employee company and the company, and what transaction should consider? Clear deliverables, SLA, arm's length, etc.
No, that's a very good question. As I said before, the KSA transfer pricing guidelines, they provide specific guidance on parties that can be considered related parties. So it's basically to have it on a higher level. There are two types of relationships. So one type of relationship is by ownership. So if someone is owning more than 50% of a company, then these two parties are considered related. The other is in terms of control. So a control can take the case, like in this example of employees that they own a company. So there is a clear relationship there. Again, is basically the main idea is that there is guidance in the KSATP guidelines, and in many cases, especially when you have effective control, the parties being involved can be considered related. So whenever you have any business decision making or any effective participation in the management of a business, then these two parties are being considered as related.
Thanks, Ioannis. And it's important to emphasize that the definition of related parties and control in Saudi is very, very wide. I think a lot of companies, they make the mistake and they assume that they're not related parties because what they consider related is different to what the regulations consider as related. So according to them, they're related if they own more than 51% of the shares, or they have assets on winding up, or for example, they may have income on distribution. But the definition of control in Saudi is very, very wide, and as Ioannis said, it extends to beyond legal ownership or assets on winding up or income on distribution. And even through a contract, you could have control, or through the arrangement in practice. So it's very important if you exercise control, even in terms of direction. So it's a very, very broad definition. So it's something that you're going to have to carefully think about. It may not even be a typical related party situation or group situation. You could have a relationship for transfer pricing purposes, in ways other than legal ownership. So that's very important to look at.
And to add on this, basically, we need always to keep in mind that when the Zakat payer or the taxpayer will have to file the disclosure form identifying the related party transactions, these related party transactions are deriving from the interpretation of the TP bylaws. So the definition is not based on accounting, or it's not an accounting definition or a legal definition, but it's a definition that is following directly from the TP guidelines. So that's something also to keep in mind, that you need to analyze your related party transactions in view of the TP bylaws and the definition of related parties as per the TP bylaws.
Okay, I'm conscious we're running out of time. I think our time is just up, so I'll just ask a couple of quick questions. Is there a threshold for the preparation of local file, master file for Zakat payers as well?
I think, yeah, this point we touched base on this before, we covered that. So basically, for local file and master file, the threshold is 6 million Saudi riyals, the same as it is in the case of income and mixed tax payers. There is no change on this. So yeah.
Okay, thanks, Ioannis. Next question: will Zakat payers be required to prepare TP disclosure form in case of consolidated Zakat return?
Yeah, that's actually a very good question. So basically, there is no specific guidance, by the way, so far in terms of who is going to file the disclosure form or what's going to happen in terms of actual filing of the disclosure form. What we are expecting is basically that in case that there is a consolidated Zakat return prepared at the group level, they will be prepared also at the local entity level disclosure forms that they should be filed together with the information return. So this is most likely the most most likely the approach that will be followed by ZATCA with regards to this.
Great, thank you, Ioannis. I think our time is up now. So thank you once again, everyone, for joining us today. I hope you found the session productive and useful. We will be sharing a recording of the session with you. And of course, if you have any questions, please feel free to reach out to us directly. Thank you, everyone.
Thank you.